Hey guys, Jerry here with Cole Banker and therealestateprofessional.com. Today I'm going to cover a couple of things very quickly. One, increase in interest rates and how that's going to affect your monthly mortgage. So speaking from the perspective of if you have already purchased a home, you're already living in your home, your term is about to roll over. Let's say hypothetically your interest rate was at 4%. You purchase a $250,000 home, and that's the mortgage you have existing in your property. At $250,000 at 4%, you're looking at $1,300 and change for your mortgage. If that interest rate, say, doubles, it goes from 4% to 8%, the monthly mortgage, on that mortgage is going to go from $1,300 to $1,900. Now, obviously, this is something that's important to take into consideration. Now, I don't really see interest rates going from the 3.25 or 3.5 that they're at right now, going to 8%, but we always refer to you looking at your comfort zone, how much you can afford on a monthly basis, and if your mortgage is at 4%, if that was to go up a half or a full percent or two, can you afford that mortgage? And that's something that you always want to take in consideration, because you don't want to be fully leveraged. If this, and we kind of see it right now, this stuff that's going on in Europe and whatnot, how we sort of see that the interest rates have sort of been kept artificially low. I don't really foresee that staying that way forever. It's not something that's going to increase overnight, but I'm thinking 3, 4, 5, 6, 7 years out, you're definitely going to be seeing interest rates at 5, 6, 7, 8, 9, 10. You don't know. Much higher than what you're going to see today. It's a tough thing to predict, but definitely when you're looking at your monthly mortgage rate today, if you're going to be owning this house for any period of time, you want to be taking consideration that increase. The second thing that I want to talk about today is how interest rates and an increase or decrease in interest rates may affect home prices or sale prices. I get this question the other day where someone says, well, if interest rates go from 4%, say, hypothetically, to 8%, do you think that sale prices will go down? Now, logically, you would say yes. If we're talking about the same purchase price and now it's more expensive to get that money, you would think that across the board, home prices would be softened by that. And that may be the case in some markets. However, historically, if you look back, we don't really see that trend. You see in the 80s with very, very high interest rates, 10, 15, 20%, and you still see some subtle increases in purchase prices. And the reason for this is that as interest rates increase, interest rates increase for a reason. They increase because of consumer confidence, because of strength of the economy. And so what has a tendency to happen is people are making more money, they're doing better, and so the increase in the interest rate doesn't necessarily have this strong correlation in the drop of purchase prices that you would normally sort of think. That being said, there certainly is going to be a softening of the market as interest rates do increase. Probably a better indicator, and if you look to the United States, of property prices falling is really more to do with how people are treating the asset that they have in their home. Are they paying down that property? Are they being frugal in how they're purchasing and making sure that they have enough equity in their home, or are they taking that equity and spending it on consumer services or pleasures, trips and vehicles and whatnot? So the other thing is inventory. So even though interest rates may not necessarily be a strong indicator of property values softening, I really think that inventory is. If you look at the U.S. and you see millions and millions of homes that are just vacant, and especially if you look at new construction and you have a huge inventory of new homes that are sat there not doing anything, that is probably a better indicator of home prices falling, because once you get to a certain critical mass, you're going to have to see a reduction in purchase prices, especially as list-to-sale durations start getting longer and longer and longer. What I'm going to do is I'm going to include a link to a really great blog post, even though it's a little old, but a great blog post, and shows the interest rates. And of course, we talk about interest rates, not necessarily mortgage rates. When we go back really, really far, say 1900s or in early 1900s, because mortgage rates didn't exist. But if you look at the article I've got below, it will show you the trend and how home prices and interest rates are laid over the same graph and how they don't necessarily correlate. It's a pretty interesting little discussion there. Anyway, if you have any questions, you can certainly email me. It's Jerry at therealestateprofessional.com, and thank you very much for watching.
If you'd like to learn more about real estate in St. John's or the services that I have to offer, please visit me online at therealestateprofessional.com. Here you'll find links to my blog, as well as to my Facebook and LinkedIn pages. You can also view other videos I posted on YouTube at youtube.com/JerryRoyals. If you have any questions, feel free to email me at jerry@therealestateprofessional.com.